When the market moves with explosive force, it often leaves behind an empty space on the chart, a gap. These areas represent a price imbalance, where movement happened too quickly to facilitate normal trading. When price eventually returns to rebalance that space, it frequently creates a reliable reaction point for a new trade. We call the bottom half the discount zone, where prices are undervalued, and the top half premium. To ensure we have the math on our side, we strictly buy in discount and strictly sell in premium. This filter is the foundation of the strategy. If a gap appears but doesn't align with the higher timeframe bias and the correct pricing zone, we simply do not trade it. This chart shows a fair value gap. Isolate a 3-candle sequence, looking for the empty space between the wicks of candle 1 and 3. Crucially, the body of candle 3 must close within the vertical range of candle 2. This same logic applies during a downward trend. Here, you are looking for the sell-side version of the gap as price aggressively moves lower. Identifying an FVG proves the market is rapidly abandoning an area. This gives us a highly specific, confined zone to wait for a price pullback before entering the trend. A variation is the breakaway gap. It uses the same setup, but the third candle closes aggressively outside the second candle's range. This signals extreme pressure, meaning price rarely pulls back deeply. We mark the third candle's body as our entry. Can you spot the difference? Pause and look at these setups. Which is the FVG and which is the bag? The right is the breakaway gap. A line from the second candle shows the third closed beyond its range, confirming extreme pressure. This is why patience is mandatory. You cannot know which type of gap you are trading until that third candle officially closes. Once confirmed on the higher time frame, we don't enter blindly. We zoom into a 15-minute chart for localized confirmation. Here, we wait for a new, smaller fair value gap to form, proving the lower timeframe trend aligns with our bias. Even a perfect pattern requires heavy market participation to drive price to our targets. Because of this, we only trade during kill zones, the specific high-volume hours when major trading sessions overlap and provide the necessary liquidity. Finally, every trade must follow a strict mechanical rule for risk management. We only take setups that allow for a minimum 1-to-2 risk-to-reward ratio to protect our capital. Dropping to a lower time frame during a kill zone allows us to pinpoint a precise entry, making that strict risk-to-reward ratio achievable on every trade. Start your routine by identifying market bias, ensuring price launches out of a higher time frame discount or premium level. Next, wait for a kill zone. Identify your 3-candle sequence and wait for that third candle to close to define your entry zone. Your repeatable checklist is bias, pricing zone, kill zone, the candle 3 close, lower timeframe confirmation, and a strict 1-to-2 risk to reward. Profitable trading isn't about predicting the future. It is about executing this mechanical checklist with total discipline.